Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan Bakke. In today's episode, I have a very special guest on, Mr. Rich Summers. I mean, this guy is awesome. This guy does everything boutique hotels. He's got a boutique hotel mastermind. I personally invest into some of Rich's deals, as
I
well as
appreciate that,
he is
man.
also doing content creation. And Rich, I think we first met at the STR Wealth Conference in 2022, was it?
Yeah, it was out in Nashville, 2022, man. And you were on stage speaking, and I was like, "Who the fuck is this cat? I got to meet this dude." And next thing you know, you're out in San Diego for a podcast. You literally walked in, and you were like, I want to invest in your fund. I want to roll some self-directed IRA money over." And dude, you were an action taker. We jumped in, connected, and you hosted a cool, badass meetup that same night in San Diego, which a lot of people showed up to, and a lot of people said some amazing things about it. So thank you for coming out, dude. And such a pleasure to connect with you, man. Thanks for having me on your show.
Yeah, there's a book called The 48 Laws of Power. Have you ever heard of that book?
No, I haven't heard of it.
So one of the 48 laws is enter action with boldness. So it knows when you're going to do something, you just go, you enter action with boldness. You go all in. When you feel like you're right about something or a person or an idea, you enter action with boldness. And that was me unleashing my inner 48 laws of power and acting with boldness. So just giving you a heads up.
Dude, I love that, man. And you know what? I haven't read that book, but that's how I live every day of my life. I don't do anything half-assed. I go all in, and you know, that's how I got out of the air traffic control career. I burned the boats, and I went all in. And I think life rewards those who go all in.
Let's talk a little bit about that. So, so you worked at air traffic controller for a W-2, and then what about before that? What did you do before that?
Yeah, dude. So my first job was working at a movie theater called Krikorian Movie Theaters out in San Clemente, California, where I grew up. I was 16. Did that for a little bit. And then in college, I got my first job in sales, and I was selling cell phones at the mall. And that was my first taste of what it was like working sales. I was a shy kid growing up. And I remember I had to stand in a kiosk and sell cell phones for Singular Wireless, and I had to say hi to strangers, and it was the most uncomfortable thing that I've ever done in my life. And I forced myself to do it over and over and over, and I ended up becoming top at sales. I'm very competitive. I played sports growing up, baseball, basketball, and I skateboarded. And so became pretty good at sales. And then I went on to sell cars for Mossy Nissan later in college. Some of my coworkers were like, "Dude, you'll make way more money over here." So I went over there, started selling cars, and I graduated in 2008. You know, wanted to sell commercial real estate because I was good at sales. And I thought, why not sell stuff that's going to give you the highest commissions? And that's really commercial real estate. And so I interviewed with CB Richard Ellis and Grubb and Ellis right out of college. And they were like, "Hey, dude, we love your hustle, but this is not the right time to get into the industry." They pulled these internship positions, and it was 2008. The entire economy was coming down. The job market fell off a cliff, and I found myself on a car lot wondering, what am I going to do with my life? And that's when I stumbled across a job with the FAA as an air traffic controller, government job. And they called me and they said, "Hey, dude, can you pass a drug test and be out in Oklahoma City in 3 weeks?" And I said, "Yes, let's do it." So I literally packed up a suitcase, and I was 23 years old, and I drove all the way out to Oklahoma City, and I ended up doing this career for 11 years, man. And it was so much fun. But I got to a point where I was like, I felt stuck. I felt like I was no longer growing, and I knew I needed to make a change. And I overheard a coworker in the break room in between work and traffic, and he said he just closed on a fourplex in Cleveland. And I was like, I thought it was the coolest thing ever. I was like, "How did you do that? And teach me how you did that." And he said, "Go read this blue book by Brandon Turner. Go listen to this podcast." It was the Bigger Pockets podcast. And I read the book, and I started just binge listening to the podcast, and I just became obsessed. It was like this whole new world unlocked. And I was like, okay, this is what I'm going to do. I'm going to get into real estate, but I'm going to be on the investment side, not the sales side. And so I literally didn't do anything for 9 months. I just became obsessed. I started going to networking events before I even owned any real estate. I started reading books. I started listening to podcasts. I literally stopped going out. And 9 months in, I ended up cashing my 401k. That was the only money that I had at the time. I had about $340,000 in a 401k. I cashed it out. I paid the income taxes. I paid the 10% penalty to the Fed. I paid the 2.5% penalty to the state of California, and ended up buying my first deal, which was 11-unit building in Cincinnati. I bought it for $350,000, and I took the rest of that money and I partnered with two partners that I actually still own a couple deals with today, but we bought and JV'd on a 32-unit building in Indianapolis, and that was all the money I had. We turned that 32 unit from 1.1 million to 3.1 million in 24 months, and then did a cash out refi from that Cincinnati property. I took it from 350, now it's worth 800. Did a cash out refi, pulled my money out, and then I learned how to raise private capital. I started a podcast in the apartment space before I owned this one, and started scaling it. And today I control about $80 million of real estate. Got a 7-figure online community, have a team, and a podcast, and we got a fund in the hotel space, which you're an investor in. Thank you so much. And now we're rocking and rolling. So my life has completely changed in the last 5 years. And for your listeners and your audience listening to this right now, I think my biggest takeaway looking back, Ryan, is, everyone told me it was too risky. When I went to cash on my 401k, when I was going to go invest at a state, everyone told me not to do it. Everyone outlined all the risks of why it would never work. And I think looking back, my biggest takeaway is this: all those risks are real, so put some weight on them. But on the other side of the balance scale is another risk, and it's this: I could be 80 years old one day, laying in my bed, staring at the ceiling, kicking myself because I never fucking tried anything in life. How about that risk? That's a risk too that a lot of people don't allude to. And lastly, I'll just say this for your audience. I was 33 when I felt stuck. I was no longer growing, and I knew I needed to make a change. I'm 38 now, and I'm just getting fucking warmed up, baby. We're about to run a lot of people over. And so my takeaway, and this is a good lesson for your audience, is no matter what age you are, it's never too late to reinvent yourself.
That's actually another one of the laws of power. It's called recreate yourself. I'm gonna show you this book next time we're in person. I'm gonna teach you.
Yeah, maybe I gotta read this book, bro.
Yeah, that's another law.
Am I speaking pages out of this book or something?
Yeah, well, it's an interesting book.
Yeah.
So I had this question I was gonna ask you. If you had if it was a book or a person that was that defining moment, and it sounds like it was a combination of a coworker and him telling you to read a book and listen to a podcast. But I had a question. So this coworker, did he tell a lot of the office that he bought this apartment building, or how did that go?
We were in a break room, and this is at SoCal Approach, which is actually the busiest air traffic facility in the world here in San Diego. We run arrivals, departures on radar for all these major airports in SoCal. But anyhow, we're in a break room, and there's people there's probably 15, 20 people in the break room, people of all different walks of life. Some people are on their phones, some people are listening to headphones, some people are watching TV. But it was really just myself and him and a couple other people that were involved with this conversation. And I was I heard it, and I was I thought it was the coolest thing ever. And one of the other folks that was involved with the conversation, his name's Sean D. Martell. Him, the guy that told me, his name's Mike, and myself, the three of us were the ones that partnered on that 32-unit building in Indianapolis. And real estate's a beautiful thing. The three of us all quit our jobs and walked away from pensions within 18 months of that conversation in the break room.
Wow, it really does sound like you were in the right place at the right time to be able to have that conversation with your coworkers. I mean, because I've seen that firsthand where I might have brought a good idea to a lot of people and only one person out of the room acts on it. How many times do we hear stories of people that they have all these great ideas, but nobody ever acts on it? And you took action. You took action back then. And you knew to take action, enter action with boldness. Was there a moment once you were in real estate that you felt that you had a lot of success? Was it with that first deal?
Yeah.
Yeah.
I agree with you, man. I think a lot of people come up to me at meetups and stuff, and they're like, man, I really want to buy a piece of real estate. I really want to try this new business venture. And they're like, do you have any recommendations, any books I can go read? What would you suggest I do? And I'm like, hey, go listen to this podcast, go read a couple books. And then I see them 9 months later. I'm like, hey, dude, how's everything going? And they're like, oh, man, life got busy. And I started talking to my in-laws, and I just decided that I was going to go a different path. And it is what it is. And I'm like, dude, you're right, man. I think a lot of people make these excuses to why they don't want to pursue their dreams. And they get in this new thing. It's the same reason why a lot of people go to the gym on January 1st, and they're like, hey, it's my New Year's resolution to get in shape. You go in the gym January 15th, and there's all these new faces in there that you've never seen before. And then they realize that the success and the results don't happen overnight, and it does require a lot of work, and it's not easy. And you go back in the gym March 1, and none of those people are there. It's the same fucking reason with real estate investing and business ventures. People like the idea. It's free to come up with an idea. but the work is actually implementing it and doing the actual work. And, you know, if it was easy, everyone would do it, but nothing easy in life is worth doing. And it's supposed to be difficult, but you're supposed to do it anyway. And I think if you desire something bad enough, you want it bad enough, you speak it, you believe it, it will happen, but you got to do the work. And, you know, I was in the same place. Everyone told me it was too risky. I'm lucky I did not listen to them. And I pushed through, I grinded, I made it happen. And the same thing will happen with your audience if you want it bad enough. But to answer your second question, you know, with the first deal in Cincinnati, dude, I didn't know how it was going to go, bro. I literally, you read the books, you listen to the podcast, you think theoretically, hypothetically, it's going to work, but you don't know until you do it. And it was fucking scary. And I made all the mistakes. I mean, I bought a $350,000 11-unit building. Yeah, it's like in a fucking C-class area called Norwood in Cincinnati. And dude, there was hookers and prostitutes in the building. 4 tenants moved out as soon as I closed. I hired the wrong property manager. So 2 months in, I had to make a pivot to bring in a new property manager. And this is all while I'm working full-time in San Diego, remote, and we're renovating some units. And this is my first stab at it. But yeah, it was scary. But now looking back, I'm like, I don't know, like at the time it was scary, but it's all perspective, right? And so now that kind of stuff doesn't scare me. It doesn't even get me out of bed, but it's all perspective because I've chose to challenge myself. I've chose to push my comfort zone over and over. And now there's things that I'm working on now that, you know, push my comfort zone, but that doesn't get me out of bed anymore.
You know, it's interesting. You talk about, everybody says, what if,
Mm-hmm.
What if the toilet goes out? What if the tenant?
Yeah.
What if this happens? But nobody ever says, what if it could be better than you ever imagined?
Ooh, that's so good.
That's what it was for me. You know, that quitting my corporate job at 23 to do this full time to inspire other people. I also think that, and there's a stat on this, but it's 5 times more of an emotional pain to lose something than it is to gain something. So for example, if you lost $50 out of your pocket, just blew away into the wind. I'm sorry, if you lost $10 out of your pocket, just blew away into the wind, you would have to find $50 in order to make up for that emotional damage of losing $10, because it's more to lose something than it is to gain. And a lot of people have this mindset. I remember when I was at Deloitte, they gave you a $5,000 bonus whenever you passed the CPA exam, but the caveat is you had to stay there for an entire 2 years in order to get that $5,000. If you stayed there for only a year, they took half of it back. And I remember at one point, this was a year and a half in, I started building up my side business. I started posting online, doing content, and I had made more money on the side than I did at my day job. But I almost didn't quit my job because I had to stay there for another 4 months in order to not have to pay back that other $2,500. And what that $2,500, I remember it being emotionally damaging to me to have to give back the money that they gave me. But Absolutely. In those 4 months, I made over $200,000 in 4 months, the first 4 months that I got out of, or the first 4 months that I left. And so that's really what it cost me. It wasn't the $2,500.
Yeah.
It could have cost me $200,000. Next thing you know, I'm there still at Deloitte. They give you a little raise. They dangle a carrot in front of your face with a promotion, and then you stay there forever. And
dude, I'm glad that you brought that up, man. It is always an opportunity cost, and it's always a shift in mindset and perspective. Same thing for me, man. Like I used to have a scarcity mindset, and now I have an abundance mindset, but I had to train myself to be that way. It's the same reason why a lot of people, you know, when they think about building wealth, their first intuition is, hey, I need to save. I need to cut out $4 Starbucks, and I need to go wait in 20-minute lines at Costco for gas so I can save $4. And you know, in all reality, you know, for that same individual, there's a lot more areas that they can focus on their attention on, a lot better choices they can focus their attention on that are going to make them a lot more money than just $4. For example, the decision to house hack is a $40,000, maybe even potentially $1 million decision, right? A lot of these credit unions out there will do no money down loans, right? So if you got a W-2 job, most of those folks can go qualify for a no money down loan, and they can go house hack, have their living expenses covered or the majority of it covered. And then think about what kind of savings that is every single month. You're saving $2,000-$3,000 every single month. And That's not to include the principal pay down, the tax benefits, and the long-term appreciation over 15, 20 years. That house will probably pay for itself and make you $1 million over 20 years, right? And people are focused on $4 Starbucks and waiting in 30-minute Costco lines for gas. Another decision would be maybe negotiating your salary at your W-2. Anyone can go negotiate their salary and make an extra $20,000, right? Focus on that. But people choose to focus on the little things. And so it's just a shift in perspective.
I'm smiling because that's how I got started, was house hacking, and I'm a millionaire now. So
there you go.
The house hacking decision, I mean, at the time I was paying only $400 a month to live when all my friends were paying $1,400 just to rent, and they didn't have anything at the end of the day. And I think house hacking is the best way to get started. I don't know how the market is over by you guys in California, but I know over here you can pick up a property for $300,000, a duplex, live in one side, rent out the other, and it works really well in the Midwest. I don't know about California.
Hey guys, if you're as passionate about real estate investing as I think you are, you need to hear about the community I wish I had when I started investing. HotelInvesting.com, our boutique hotel investing mastermind community, is a group of 50 plus like-minded investors all building their portfolios in the boutique hotel space. We teach everything from how to source the right deals, how to get these deals deaded up, how to raise private capital, how to manage and operate, but ultimately how to 2 to 3x the value of these hotels in just 12 to 18 months. But more than that, it's about being part of a community that pushes you to grow and succeed. So if you're ready to take your real estate game to the next level, visit hotelinvesting.com to book a free call with our team. Again, it's hotelinvesting.com to book a free call with our team. Now back to the show.
Yeah, no, it works. It works great out here in California too, man. I think the house hack strategy works pretty much anywhere in the country, and I feel like it's the easiest path for the everyday person to become a millionaire. And for some reason, it's not taught in school.
But what you were saying there, as far as the spending time thinking about things that aren't important, like I have my own groceries delivered. I don't cut my own grass. Obviously, most of the stuff that's these remedial tasks, that they're automated because I don't want to have to spend time out of my day thinking about it.
Mm-hmm.
Addition by subtraction, right? A lot of people that I work with at my consulting firm and my accounting firm, a lot of people will think that in order to grow, they need to add on to their portfolio, like they need to buy more properties or buy more units. Sometimes there's addition by subtraction, right? They can sell properties that have a lot of equity and then use that to pay off properties that have high interest debt. A lot of people think that in order to grow, you need to add, but sometimes you can add by subtracting, right?
Yeah, absolutely. Also, I think a big part of like getting from point A to point B is about saying yes to opportunity, but from getting from point B to point Z is about saying no to a lot of opportunities and just focusing on that one thing. And so, there's levels to the game. And, I think in order for us to get to that next level, sometimes it's about saying no, just like you alluded to.
When Michelangelo, Michelangelo, the old sculptor, painter guy.
Yes. Yeah. I learned about him in history class when I was in middle school.
So when Michelangelo came up onto that big block of concrete, he didn't look at it and say, we need to add more to it. He said, we need to start chipping away and subtracting from it. And that block of concrete became the statue of David. He didn't look at it and say, we need to add more. He said, we need to take away from it. And what in your life right now can you take away that's going to incrementally add on to your life? Right.
That's a good question, man. That's a good question that everyone should be asking themselves. I got things right now that I'm constantly removing. I think for me, whenever I need to reframe and refocus, what I like to do, and this works for all aspects of life, but especially as entrepreneurs, real estate investors, we have a million things going on, and we also have a lot of ideas. And so sometimes I find myself being like, fuck, I'm focusing on way too many things. I need to reframe, refocus. So I always identify, okay, what are my rocks for the quarter? What are my 1 or 2 rocks? I'll write them down. And then I'll write down all the 35, 40 tasks that I'm currently spending my time on. And I'll go down each one. I'll be like, is this helping me achieve these 1 or 2 rocks? If it is, I'll leave it on. If it's not, I just cross it off. And by the time I get done with this exercise, I'm like, oh, there's only like 4 things I should be focusing my time on. And it helps me reframe, refocus. And that's a good strategy I think anyone can use.
Well, I feel like we got enough mindset for a long time. That was really good, Rich. I want to shift over to kind of more the deal analysis side. What are some of the key things that you look at anytime you're going to enter a specific market? Is it the location, tourism, the density? Like, what are some of the non-numbers factors that you look at? for a deal?
Yeah, so we own apartment buildings and boutique hotels, and right now we're buying boutique hotels. We're still own apartment buildings. I'm just not buying that stuff right now. So traditional real estate investing, you always want to look at employment growth, population growth, good fundamentals, and but with boutique hotels, it's a little bit different. Right. So I think traditional real estate investing, a lot of folks like landlord friendly areas for obvious reasons. I think in California, you don't own your real estate anymore. Gavin Newsom does. And for boutique hotels, we actually look at the opposite because we want to go into areas that have bureaucracy, they have red tape and tightening Airbnb regulations. More liberal areas tend to have tighter and stricter Airbnb regulations. And that's great for boutique hotels because as those Airbnb regs tighten, it actually brings more demand to the boutique hotels, which is a good thing. And so we actually look in more liberal areas such as California. We like coastal stuff. We like stuff in great locations on the water or close to the water. We like stuff that's tired from mom and pop sellers, stuff that hasn't been renovated in decades, properties that are underperforming because they're not utilizing any technology. There's 40 million baby boomers retiring in the next 7 years, and it's estimated that 25% of them own boutique hotels that are priced 10 million and under. And so I see it as a huge opportunity to come in and pick up these deals at a discount. A lot of these mom and pop owners aren't utilizing any technology. They're just relying on a direct booking site. And a lot of them aren't even using these OTAs such as hotels.com, booking.com, Expedia. And so you simply coming in as a hotel operator and throwing these rooms on these different OTAs is going to give you a lift without having to do any work. And then you throw in the renovation package and improving the aesthetics of the property and the experience for the customer and the guests. Then it's a secret sauce. And that's where you see a lot of appreciation and growth. Boutique hotels are commercial real estate. And so I think you can see these big pops. We can often 2x the value of these properties in 12 to 18 months. We're not able to do that on the multifamily side right now.
Yeah, that's interesting you say that. We bought a campground / RV park that was doing about $800,000 in total revenue from the bookings and then the store sales, and we also had fuel. Okay. And they didn't even have they took all their bookings by pen and paper with a phone number online. They didn't even have any way to Instabook or direct booking or barely even a website. Within 1 year, we went from 800,000 total sales to almost $2 million in total sales. Damn. Literally just by the marketing. Like having somewhere for people that easily book, have a retargeting campaign set up for people who hit the page but don't book, pixel them and do all these marketing things. And it is surprising the value that's out there that people don't want to go create, or they don't even know. It's really more of a knowledge issue. Those mom and pops don't know that they can go and create that value because they've been doing it the same way forever.
Yeah, I feel you, man. I think that's where you're going to see these big gaps in terms of underperformance and where you can currently buy, and then stabilize value and where you can kind of operate at. I think that's the opportunity right now is that kind of stuff, and then also I think ADUs is a big play. The ability to go build ADUs in expensive neighborhoods is a big play right now.
And so walk us through a little bit about when you're looking at a deal. Let's say it's already an existing boutique hotel. Are there any metrics that you care about the existing property as far as like, does it service its debt right now? Does it cash flow now? Or are you more worried about what you're able to do to it?
I'm not really too concerned about what it's doing right now because I'm looking at what we're going to be able to do through our marketing, through our operations, through our business plan. And so I'm looking at stabilized comps. How are they performing? I'm looking at similar properties within a X mile radius and seeing how they're performing. And so if I got some other comps in the area that are performing really well, that maybe have better marketing, they have better operations, they don't need to be renovated. Sometimes you'll see a comp out there in a smaller, more rural market that is not renovated, but it's another hotel that just has good operations and they have good marketing, and they're doing 3-4x the revenue that your subject property is doing. Well, hey, that's a huge opportunity for us. And then if we do a renovation, we can probably take a lot of their customers. And so that's a lot of the stuff that we're looking at. We're looking at really post-stabilized value and what's this property going to be worth on the back end. And what does the refi scenario look like? And what does the return profile look like for the investors? I mean, at the end of the day, that's the main thing you want to look at is what does the return profile look like for the investors? And if it's a deal that you don't have investors, what does the return profile look for you as the sole operator?
Because typically, post stabilized, once the property's stabilized, how long of financials do you have to have in order to refinance and get money out?
Yeah, it depends. I think traditionally speaking, like if you want the best possible chance of securing the best lending terms, they're going to want to see 12 months of trailing financials, a nice clean T12, or even a full year of income on a tax return. Now, there are perm debt lenders out there that will do something a little bit shorter because anything's negotiable. So I think as long as you got a good trailing 6, it's probably enough to get some pretty decent long-term debt.
And what do you guys use for deal flow? Like, are you using Crexy or any sort of? Because I know for me, at least in my area, by the time a commercial property hits the market on one of those websites, it's already been picked through, 10 or 15 investors that have already, and the broker came to them first originally, and then by the time you see it online, it's like it's already been picked through. Like, how are you guys acquiring?
Yeah, that's a good question, man. And you brought a very good point. So often when you find these deals on LoopNet or Corexy, they've already been shopped by a lot of the buyers that the broker, maybe shopped first. And then when those buyers pass, then it might hit the market and be on Corexy and LoopNet and that sort of thing. So it's really a numbers game. So I always say if you're brand new in hotel investing, and this works for all assets, multifamily, self-storage, all that stuff, it's really a numbers game, and you really want to, network with as many brokers as you can. I always say if you don't have the deal flow that you're looking for, it's simply because not enough brokers know who you are. And so you got to pick up the phone and you got to put in the work. You got to introduce yourself and call all the brokers in the market, and you got to build rapport. You got to build trust. You got to get them to like you. And it's a numbers game, and it's right time, right place. A lot of it. A lot of the deals that we bought is because we're in the broker's ear, and the broker's like, hey, you know what? I got something in my pipeline that I haven't started marketing yet. Can you sign this CA and I'll send it over to you? And now you got first look at an off-market opportunity, and you weren't one of those buyers that has transacted with the broker, but because you're calling them every single week and blowing them up, right time, right place, you're going to have first crack at it. So if you find one of those deals and it makes sense, I always do a quick underwriting. And if it makes sense, you move quickly on it, go tour the property and go to LOI quickly, and you got to lock those deals up. And so that's one. But I also tell your audience, like, don't overlook stuff that's on LoopNet and Crexy because it's been sitting there for a long time. Often deals go there and they sit on market for 180 days, 360 days. And it doesn't mean that it's not a good deal at a specific number. It's often been passed on because the pricing expectation of the seller is too high when they initially brought it to market. Now, when the seller doesn't have any offers for 11 months, and then you bring them an offer at 65% of the listing price, and they counter down to 75%, now hey, we got a seller that's willing to play ball right now. Their expectation has adjusted, and now you have a good opportunity. So I wouldn't overlook those deals either.
Well, that's good. That's good to know. So have that sort of Rolodex of the brokers that you've worked with in the past, or new brokers that can send you deals. Have you ever done any direct mail to the mom and pop owners too, or no?
Yeah, we're always building rapport with a lot of these owners. We've never done any direct mail, but whenever we buy these properties, I always try to network with the other hotel owners in the area. And so, for example, Black Sands Inn, this is the first hotel that we bought up in Shelter Cove, California. And directly next door, there's another property up there. It's called the Oceanfront Inn. And this particular owner, they've been in the hotel game for a while. They're mom and pop. They own that deal. They own another deal in South Lake Tahoe. And, I've been building a rapport with them. And I know, hey, I want to own that property next door because it's going to allow us to share a lot of the expenses. We can share the same staff, we can share the same housekeepers, and so reduce the operating expense for both properties. And that property has a big parking lot. Those rooms complement ours. Ours are like big with living rooms, kitchens, fireplaces, and those are like more like single suites. And so the properties would do well together. And so I always tell them, I'm like, hey guys, whenever you guys are ready, I would love to have an opportunity to buy this deal off of you and create a win-win situation for both of us. And, they're willing to sell or finance. And so they called me a couple months ago and they said, hey, we're finally ready to sell our South Lake Tahoe deal. Why don't you come up? We can go to lunch, tour the property, and we're willing to sell or finance it to you. And so I didn't end up moving on that deal because after doing a little bit of research, it's not a deal that I want to buy. But we're first in line to buy this other deal next to the Black Sands Inn when the time comes, because we built rapport. And so I think the lesson for your audience is like, real estate is a people's game. And if you're not making the kind of money you want to be making and you're not getting the deal flow that you want, it's because you're not shaking enough hands. And so get out there and shake hands because you never know who you're going to meet.
That's really good. This is a tax podcast, so I have to ask you, do you have any favorite strategies that you've learned about over the last couple of years that you personally use or you see other people do?
Yeah, well, I think the STR loophole is a big one, and you can apply that to hotels, which not a lot of people realize. And so maybe we gotta deem this and trademark this, but we got to come up with a good name for it. I don't know if we want to call it the boutique hotel loophole or what, but your audience, you can, if you're working a full-time W-2 and you're a high-paying W-2 worker, you can go buy a boutique hotel. Some of these boutique hotels out there you can pick up for, like, we got some folks in our hotel mastermind. They just joined 2 months ago. They're buying their first hotel. They're under contract right now. It's a 16-unit boutique hotel in their local market for $750,000. So they're going to put down like a couple $100,000, and they're going to get into a 16-room boutique hotel. And now they can get a cost seg study, and they can depreciate all the depreciation and use that not only to offset the income that hotel will spit off, but also use it to offset the income that they might pay at their W-2 job. And so I think that's a powerful play that not a lot of people talk about. And so you're hearing it right here on the podcast, Ryan. Maybe me and you we gotta nickname this this term here, man.
I helped Jesse Vasquez with the midterm rental loophole, so
okay.
I'll give the name for this one.
We got to come up with something a little more creative, though. Yeah,
with
the loopholes, man.
It's also, though, with combining that with potentially taking money out of the 401k retirement, right? Ooh. So if you're high W-2 making 300, 400k a year and you go pull out 300k, like you're going to give away half of that to the government and fees and taxes. But if you combine that with placing that property in a service that year, you can use the depreciation that you get from the hotel to offset your retirement income withdrawal.
That's a very, very good point, man. That's a very good point. Actually, one of our investors, I believe, jumped on a call with you last week, but they pulled out a lot of their 401k to invest in our fund. And then they hit me up. They're like, hey, we got a little bit of a tax bill, but it's like, dude, the time to plan for that would have been last year in 2023. They should have bought another asset, to utilize that depreciation to offset it, because they're still working high income W-2 jobs. And so had they bought a short-term rental or a small boutique hotel, at the end of last year, then they could have capitalized on that program.
Yeah, that's the sad thing about it, is a lot of people don't think about it until it becomes a problem. It's like going to the dentist and having 5 cavities when you could have just flossed and brushed your teeth every day.
Yeah.
So people don't think about it until it's past April and it's a huge issue. So, but yeah, we'll have to dive more deeper on this. We'll figure out what we'll call it later. Boutique hotel loophole.
Yes. There you go.
Well, thanks, man. Thanks for coming on the show. Where can listeners of the podcast find you?
Yeah, man. Appreciate you having me on. Everything's on Instagram at Rich_Summers. That's SOMERS. And if you want to check out the podcast, it's the Rich Summers Report. I rep 3 podcasts a week, bring on really cool guests like Ryan, NFL athletes, people of all walks of life, Botox doctors, and all the above. And I also do some one-on-one stuff, just solo podcasts, more mindset and stuff like that to get you all pumped up. But that's the podcast. And then, everything else is Rich_Summers. That's SOMERS.
Awesome. Thanks so much.
Cool, brother. Appreciate you, my man.